All right, we are live, like I say every day when we start this live stream. Welcome back, investors, to Ticker Time News. I am Adam, and the major indices enjoyed a nice rebound today. But was that really asking too much of the market to rebound after the steep fall that we've been in over the past several sessions? To give you a perspective, the S&P 500 was down 10.4% from its intraday high last Monday, and the Nasdaq Composite was down 11.6%. To say that the market was oversold on a short-term basis was not an overstatement. The magnitude and speed of these losses left it ripe for a rebound try, and it garnered support from a synchronous rebound in the Treasury market and the FOMC decision that went mostly the way we expected, at least from recent news articles. The FOMC was a big deal today, and it had the momentum, like I've been saying, to move the market, and it did. But what's going to happen next? Is this rally going to continue? Can we push higher, or are we destined to fall lower? Well, I'm going to answer those questions and more in today's video. This live stream is for you. So if you do have a question, leave your ticker symbol and question in the comments. We'll go over it live during this show. Now, I'm going to try to get everything that I have jotted down out so you can digest the information, because it's a bunch of it. And I said this earlier this week in one of my live streams that I thought it was one of the most important live streams that I've done to date. Well, today, I think tops that. I think today is one of the most important live streams that I've ever done. I've done now over 150 of these live streams nearly every day the market is open. So sit back, relax, get your notepad out. You might want to take some notes with this information, and get your questions ready, because we will answer them. All right, let's just dive right into this now. The FOMC voted to raise the target range for its Fed funds rate by 75 basis points to 1.5 to 1.75%. That's where rates stand at right now, and is said that it anticipates additional rate hikes, and they will be, quote, appropriate. Just let that sink in for a moment. This was the biggest rate hike since 1994. 1994. And the vote for a 75 basis point rate hike was not unanimous either. Kansas City Fed President George dissented, preferring a rate hike of only 50 basis points at this meeting. I don't agree. I was in the camp of 75 to even 100 basis points. Let's just get it done. Let's just get inflation under control. So in reality, the Fed really didn't give us anything new. It didn't give the market anything it didn't already know from the Wall Street Journal report on Monday. Now, I really believe that my theory about the Fed contacting the Journal and journalists about leaking this information about 75 basis point rate hike just to see how the market will react is actually what happened. Now, here's what I told investors on Patreon on Monday. And remember, on Monday's live stream, I did not want to share everything on that live stream that I told our investor community, because I didn't believe that it would be fair or the right thing to do. But now that we're over this hill of the FOMC meeting, I think it's fair to share what I said. So I'm going to open that note up, and I've highlighted a few of the important parts that I want to share. Some of the information I've already talked about during live streams. Some of it was withheld. Now, here's what I said. A Wall Street Journal report suggesting the Fed is apt to be considering a 75 basis point rate hike at this week's meeting, given the worrisome data in the May CPI report. See, that CPI report that came out last Friday, that was the big shake the tree, get the Fed to act moment, where they had to stand up and do something. And they did, I believe. Now, it goes on. The timing of the article and the journalist writing it is what has upended things late in the market. Because remember, the market sold off when this information came out. There is bound to be speculation that the journalist is a credible source for floating a, quote, trial balloon, so to speak, to see how the market reacts to the idea of a, quote, surprise 75 basis point rate hike. The initial reaction has not been good, but the stock market is also desperate to see some progress on slaying inflation. So it might just be in a mode of, quote, seeing is believing, creating a possible sell the rumor, buy the news setup at the moment. And that's what we got this today, ladies and gentlemen. All this week, we have been red and falling hard in the market. You can see this is the S&P 500 right here in front of you, a daily view. So each candle equals 1 day. We've been falling all week since last Friday. Big too, big drops. And what happened? We sold the rumor and we bought the news. When the news came out at 2 o'clock Eastern, the market started to rally. And we'll look at that in greater detail in just a moment. Now, real quick, if you would like this valuable content to help you along your investor journey, then come join us by clicking the first link in the description. The investor community and I would love to see you there. So click that first link in the description and come join us in beating this crazy market. Now, before we dive into the details of the economic projections, I want to look at a chart real quick. It's a seasonality chart of the S&P 500. Real quick, I'm just going to hop over to the chat. Maybe we were just too shy about doing rate highs in the past. Maybe the quantitative easing was overdone. That's a good point there. I do believe quantitative easing was overdone. There was too much stimulus in the market, and that caused this great rally that we had over the past 2 years. And now, well, that the Fed is changing its tune and not putting cash into the market, but rather taking it out, which remember began at the beginning of June, so just 15 days ago. Money coming out of the market means the market goes down. So good observation there. Next one. It was entertaining to see the market move before, during, and after the speech. Yes, it was. There were definitely stages in the market today based on how and when the information came out. Okay, on this chart right here, this is an S&P 500 seasonality pattern chart. This chart goes from 1946 all the way up to 2021, I believe is the end date. Now, this is a pattern that the market will follow based on S&P 500 midterm election year. Now, the black line and the red line, those are the only two lines I want you to pay attention to. The black line is what the S&P 500 on a seasonal basis will do. And you can see January starts off kind of flat. It picks up in February. It flattens out again. It picks up in March, April, May. And then we flatten out through June, July. Little uptick in August, September, October, kind of flat. And then we get the end of September dip, which then leads to the end of October rally, right? That's normally what happens on a seasonal basis on the S&P 500 during midterm elections. Now, the red line, this red line is the second year new Democrat Party president. And that's exactly where we're at right now. We are in President Biden's second term in office. Now, or second year, my apologies, second year in office. The red line, look at this. January, we start off very choppy, headed lower. February, very choppy, headed lower. March, we hit a low. And then we start to climb a little bit. And on the chart now, our real chart, what did we do middle to end of March? We rallied. That was our snapback rally after the death cross. So we get this rally and then we fall in April. We rise again to the middle of April, and then from the middle of April all the way to July, we fall, and we fall hard. Look at these steep drop-offs. Right here before June, a steep drop-off. The middle of June, and wouldn't you know, we're in the middle of June right now, and a steep drop-off. You could say that, and I wish I had drawing tools here, but if you look at the chart where it says June and July, right between those two lines, the red line here, there is a peak right there. That's the middle of June. And then that first little drop off there, straight down, that could be what we just saw over the past few days. And what's in front of us is an even steeper fall into the end of June. And then we rally in July, August, we fall all the way to October, and then we rally from October there on. This is a very interesting chart, and it's got a lot of history to back up these different moves. So the black line is normally what happens. The red line is where we're at right now today. I find it so fascinating. Let's see here. Going back to the comments. And I should do this. I forgot that I can do this now. There we go. Mostly declines beginning in May and rally in November, sell in May and go away. Yes, that is a typical phrase or adage in the market. Sell in May and go away. A lot of times we have a September sell-off, and then sometime in October is when we gather up our steam to rally into the end of the year, like rallying into the close, right? So yeah, I totally get your phrasing there, and it definitely works. Now, this bottom right here at the end of October for the red line, all the way to the bottom right of this chart, I want you to keep that in your mind. We're going to go to the S&P 500 here. I'm going to take volume away so we can see things a little more clear. I need to back out just a little bit. Remember my yellow box all the way down here? And I told you guys when we looked at this, this is sitting for the S&P 500 somewhere around 3280 to maybe 3900. And the time period is October. So when I found this chart yesterday, I thought this is very interesting because that bottom kind of correlates and matches, not correlates, but it matches up with the October bottom I have down here in this yellow box. Very interesting if we continue following along this downtrend line, and you can see the 4 marks that we've had on this trend line. It's just matching up almost too perfectly for the scenario that we're in, based on the historical patterns that the market goes through. So I found that very interesting. So I wanted to bring that up during the live stream, and we can move on off of that now. As a matter of fact, I'm going to close that window out. Actually, would you guys like to check this website out? I'll do this. I'll close it out. We can close out this one as well, so that way we don't end up lagging. And in the comment section, I'm going to post a link to that chart so you can check it out for yourself and see what you think about it. All right, moving on now. The company summary of economic projections is something else that we got today, and it was revealed there was an upward revision to the median estimate for PCE inflation to 5.2% from 4.3%, and core CPE inflation to 4.3% from 4.1% this year, and a downward revision to the change in real GDP. Now remember, we already got a reading for real GDP, and it was nearly at 0 for the second quarter. But the Fed sees the real GDP at 1.7%, and that's down from a 2.8%. They also see higher unemployment, which I do too. I think companies are going to start taking those millions of jobs that are open and on the market, companies are going to slowly start taking those jobs off the market so they don't get filled. And that's one way to hurt the unemployment rate without firing anybody, right? But the Fed sees unemployment higher, and they went from 3.5% up to 3.7%. So not a big change, but a noticeable one. And most importantly, a sharp upward revision to the median estimate for the Fed funds rate. They now see it at 3.4% at the end of this year. And guess where they were at the last meeting? 1.9%. So they think rates are going to go up, and they're going to go up very quickly now. Okay, we can also defer. We can not defer. We can differ on these numbers that the Fed gives out, like real GDP at 1.7%. I'm sorry, no, I feel it's much closer to zero or even negative. Remember, Q1 GDP was negative 1.5%. Do you think that our economy is running more efficiently and running more hotter now than it was a month ago? I just can't see it. To me, the consumer right now is being weakened. You see all of these charts about consumers now getting out of their savings account because they've drawn it down so far and going into debt, credit cards. That's not good for the economy. We should be putting more money into savings, but inflation has made that damn near impossible. It's hard to do. And Jerome Powell came out and he believed that the consumer was just fine. The consumer was healthy, and he didn't see any major warnings or anything of that nature to warrant the consumer getting weaker. I'm sorry, I'm not with you on that one, Jerome Powell. I see the consumer being weakened. I can see it in my own life with inflation going up on food and gas. Two big ones there. Now, the range of projections for the 2022 Fed funds rate is 3.1 to 3.9%, and was more in line with what the Fed funds futures market had already priced in. So there weren't any major surprises in the Fed's revised interest rate projections. We knew it. The market already had it priced in. Back to the comments. Growth may be stopping in the near future. I totally agree with that. I think growth is slowing. I'm sorry. Excuse me for doing that. Got to wet that whistle. Yes, I completely agree. Growth is slowing. Earnings growth, for example, companies have not come out except for a handful, and said that, you know what? Next quarter is not going to be as good as we thought it was. So we're going to lower our projections. Only a handful of companies have done that. There is a lot of guidance inflation that's out there right now, and it needs to be adjusted for where companies are really going to be. And it's not going to be pretty. It's going to hurt. And we know this. Now, the understanding was a bit of a calming influence that enabled the market to stand its ground during the time when Fed Chair Powell had his press conference. And let's look at that. I'm going to go to the 5-minute view on the S&P 500 here. Let me turn volume back on for a moment. And I'm going to zoom in here. And let's look. So there's a little bar graph here to the left-hand side of the start of today, right? This bar graph here is showing you the different price points. This is called a volume profile, and it's showing you the different price points that had the greater volume. So it's a really interesting tool. You can get to it on TradingView. Go to indicators up here and type in volume profile. And there are a few different options to choose from. Some can give you a daily view of what it was like, and some can break it down as detailed as this for the individual price points on that particular day. So volume profile is what this indicator is called. And what it shows us here is the biggest line, and it gives you a red line going across. That's at 37.90. That had the most reactions, and that was all in the afternoon after Jerome Powell in his press conference. And you can see this at 2 o'clock sharp, the market drops, right? The market falls on that information. And I'm going to get my little highlighter out here so you can see it right here. This is when the market got the press release. Okay. Got the press release. Is that a little better color? I don't like how it's so. Here we go. There we go. This is the press release, right? And then the 2 or 10 minutes, since it's a 5-minute time frame, these two green candles that go straight up over a 10-minute period, that's when Jerome Powell came out and started talking. About 10 minutes after, right? So he starts talking and the market jumps, and it jumps hard. But what happens? It's something we've seen all throughout 2022. Sell into strength. That's what we saw. People wanting to close out their positions. Traders wanting to dump their positions. Investors wanting to get out of positions. But they didn't want to just take a huge loss. They were hoping, because remember, we looked at this during yesterday's live stream. Last time the Fed came together and they had this little conference and Jerome Powell came out and talked, we had a spike in the market. I think investors, after this big fall for several sessions now, wanted this rally so they could offload some positions and close out of some positions. And that's what happened. I actually closed out my SPXS, my short position for the S&P 500 today before the press conference. Now I'm looking to get back in because I do not believe we've seen the bottom yet. But I do believe that we could see a little rally. But what's important here is follow through. And I'll talk about that in a little bit greater detail later on in the live stream. But look right here. This mark right here. This was a resistance zone that smacked the market hard. And this is at 38.36. It stopped the market dead in its tracks. It couldn't go higher. And then the panic set in. This is it. This is the rally we're going to get. We need to get out now. And that's what happened. And that's why we sold off into the close. So that's my kind of the breakdown there of the reaction this afternoon and what market participants were thinking about. Okay. So let's keep marching on. Now, with the press conference, which featured a declaration from the Fed chair that he does not expect a 75 basis point rate hike to become commonplace, meaning he doesn't want to do them, period. He would rather not do them. And an allowance, though, he gave himself an allowance, though, a little bit of an out, that the July meeting, which, remember, we have been told it would be a 50 basis point rate hike during the July meeting. Well, Jerome Powell has set the stage for either a 50 or a 75 basis point rate hike during the next meeting. Inflation reads each month will be the driving force behind these future rate hikes. If inflation continues to rise like it did on Friday's print, we'll see 75 points. If inflation flattens out, then we'll see 50 points. And if inflation somehow magically drops and falls, then we'll get a 25 basis point rate hike. So it all has to do with the monthly inflation read, CPI, PPI. What is it saying? What is it saying specifically about inflation? And then you will know what type of rate hike we will get in the future. So it was an interesting way that he laid that out, keeping the door open and the possibility saying that it depends on inflation and they're going to watch it closely. Now, by the closing bell, though, the S&P 500 was little changed from the level where it was trading at just before 2 p.m. And that's this red line right here. All right. This red line sitting right at 37.90. That's about where it started before the press release and then after or at the end of the day. Big drop, big little rally there, and then a sell-off into the close. Now, just before the 2 p.m. Eastern release of the policy directive, that's what the press release was, a policy directive. What that suggested to me is that today's gains were driven more by a rebound-minded action following the large losses that we've seen over the past few sessions, rather than by a genuine excitement over what the FOMC and Fed Chair Powell communicated to us. Now, to be fair, though, the 2-year yield and the 10-year yield did move lower following the Fed's communications with us today. Treasuries were already rallying from their own short-term oversold condition, but the gains were extended after the close of the Treasury market session, when Fed Chair Powell actually began speaking. Let's look at the 2-year. US 02Y. That's the ticker you can use. And remember, you can do this at home. There's a link in the description of this video to TradingView. Click on it, sign up for a free account, and you're good to go. And you can follow right along with us. I'm going to go back to the daily view here for the 2-year, and you can see this big red candle sticking out like a sore thumb. Now, Treasury yields in the 2-year are starting to go up a little bit in the after hours, 1.4% already. So that could give us some clues about tomorrow and Friday, and even maybe next week. And remember, the 2-year is sensitive to the Fed funds rate. So when that goes up, the 2-year goes up right along with it. Now, the 2-year did close today at 3.23%, and it's just slightly up above that right now. It was down 20 basis points from where it settled on Tuesday. Whereas the 10-year, and we can look at that by going to US 10Y, that gives you the 10-year, and we have the same thing, a big red candle for today. Now, the 10-year yield was at 3.32%, down 16 basis points from where it settled on Tuesday. That move was likely aided by some short covering activity. But in any case, it didn't corroborate a bearish takeaway from what we learned today. A mixed batch of economic data, which featured weaker than expected retail sales for May, and the Fed's downward revision to the change in real GDP for 2022. It could be considered bond-friendly. But by and large, the market participants were very friendly to the majority of stocks today. Advancers led decliners by a nearly 3-to-1 margin at the New York Stock Exchange and at the Nasdaq. 21 of the 30 Dow Jones stocks ended the day with a gain, and 10 out of the 11 S&P 500 sectors on the right side of my screen right here, you can see all the sectors. They are all in green except for one. So 10 of them closed higher. The lone standout was energy, the energy sector. And I'll put that up on the chart here. The ticker is SPN. You want that energy one. There has been a cooling off pullback period here in energy. I do find it interesting that it bounced and closed above its 50-day moving average. And remember something that I used to say all the time on these live streams about the 50-day moving average. Bullish above, bearish below when it comes to that average. All right, back to the chart right here. I'm sorry, not the chart, to the comments. The market rallied after the close, dead cat bounce. That's what I think. You can call it a dead cat bounce. You can call it a bear market rally. Either way, I have a couple of thoughts on where I think the market is going. I'll get to those in just a moment, but you're on to something. Definitely are, I think. Okay, the energy sector today, it got clipped by lower oil prices, which is a real good thing for all of us. Now, let's look at oil. US OIL. Oh, got to get my cursor to the right place. US OIL for looking at WTI crude oil. And you can see for oil, it fell to its 21-day moving average, and that acted as support for it. But it did fall 3.1%, down to $115 a barrel. It's starting to creep back up now. One of the reasons oil fell today was, I think, a bit too harsh of criticism towards oil companies by President Biden, who said refinery margins well above normal, quote, at a time of war are not acceptable. Well, I'm sorry, Mr. Biden or President Biden. I did not know America was at war. Has Congress authorized the U.S. to be at war, and to which country? I get the sentiment. I understand. Russia invaded Ukraine. We sent weapons to Ukraine to help them fight. Excuse me. However, it's created a mess for a lot of people, a lot of companies. And I don't think blaming oil companies when pipelines were shut down, when approvals for fracking or drilling were denied, can be blamed on the oil companies. The profits oil companies make during times when we have scarcity of oil is used to fund new drilling, new fracking, new ways of collecting energy that are actually better for our planet. How about nuclear? That's a good one. And I believe it's become pretty safe. Now, I don't particularly talk about politics during any of these live streams or any of my videos at all. But I just felt like I just want to get that out there. I don't think the oil companies are really the ones to blame, or anyone for that matter. This is just a bad situation, and we've got to work through it and find better ways to move forward. All right, moving off of that touchy subject, I often talk about mega cap stocks because those are the ones to watch to see how the market will react. Now, the mega cap stocks were definitely key movers today, as predicted. The Vanguard Mega Cap Growth ETF, the ticker symbol is MGK. I'll put that on the screen here. It was up 2.6% today. 2.6%. And then what happened with the other ETF that I use to compare this with. I'll mention that in just a moment. I don't want to miss your comments here. Let's see. Let's pop this one up. Why the U.S. open up sales of its oil reserves seems contradictory. That's a great question. Should we be diving into our reserves right now? I don't think we are in a time of war. Sure, letting out a little bit of the reserve could help, maybe with a penny off of gas prices, but it's not going to do the trick. I think the reserves should be saved for when they're really needed. Now, gas prices going up right now, there are ways to fix it. And they're too high right now, and they're affecting everything. Just think. There are companies right now going out of business because fuel is too high. It can't be sustained. We have to do things that may be a little friendly to oil that we might not want to do, but we need to do it. Okay, mega cap growth, ticker symbol MGK. It was up 2.6% today. Now, the Invesco S&P 500 equal weight ETF, which the ticker symbol is RSP. Get the cursor back over here. RSP was only up by 1%. So there was a big difference between the mega caps, excuse me there, and the equal weight S&P 500. 2.6% gain versus a 1% gain. The mega caps were leading the rally today. And just think, some of the mega cap names, Apple comes to mind. They were down quite a bit. They've got big pull in the market. Now, in other important central bank news today, the ECB held an emergency meeting to develop a plan that it believes will mitigate the bond fragmentation issue in the Eurozone. Now, why am I talking about Europe when we're focused here on the United States? Because what happens to their central bank can be an indicator to our central bank. Now, the ECB's action prompted a rebound bid in Eurozone bond and equity markets. So they rallied, which had also gotten into a short-term oversold condition. Now, to my surprise, moving off of that to another topic, the MBA mortgage application index this week, it increased 6.6% over a week, with purchases and applications up 8%, and refinancing applications, they were up 4%. Now, I guess the small retracement in mortgage rates over the past couple of weeks encouraged people who were sitting on the fence to make their purchase now before rates went higher. Now, I really do not believe this. I thought it would be down again, but I think my rationale for why it popped 6.6% this week, it makes sense. Those on the fence, they wanted to close their deals on real estate before the Fed really jacked up rates. So let me know what you think about that one. Then total retail sales decreased 0.3% month over month. We were looking for a gain of 0.2%. So nearly a 0.5% difference in retail sales falling, which makes total sense to me. I don't know why the consensus was so high. The consumer is being weakened right now. We all know it. I think the government needs to get on board. The Fed needs to get on board. Now, following that loss in retail sales, the revised position was a gain of 0.7% in April. So a big drop in sales. not to my surprise. Now, if you exclude autos, which are rather expensive, retail sales increased 0.5%, but the consensus was a gain of 0.7%, a 2% difference. That's not as bad as the 5% swing when you include automobiles. And of course, that followed a revised gain of 0.4% in April. The main takeaway here is that spending activity weakened in May, with gas prices likely having a big impact on discretionary spending on goods. Now, excluding gas station sales, retail sales were down 0.7% month over month in May. So they were even worse when you take fuel away from gas stations. Interesting. This could eventually pique concerns that the Fed will be raising rates aggressively into an economy that is slowing down. I mean, it is. The economy is slowing down. There's not much we can do about it. Okay, back over to comment section. It does make sense that it was probably mortgage renewals. Okay, that works. Yep. I just think it was the people on the fence there. They want to get those mortgages done before the Fed comes in and does their thing. So you're on the right track there too. I greatly appreciate it. Okay, still got a couple things to talk about. Now, Jerome Powell said during his press conference that the consumer is healthy. Now, we know different. We know the consumer is being weakened right now by high inflation. So either the Fed is lying to us or the Fed is right and we're wrong. But I don't think so. All right. We also got the New York State Fed's Empire State Manufacturing Survey for June. And it's weaker than expected at negative 1.3. Consensus was a 3% gain. But we lost 1.3, negative 1.3. But it was improved from April's reading to a loss or negative 11.6. Whatever it is, a number below zero indicates a contradiction in manufacturing activity. A contradiction in manufacturing activity. Manufacturing activity is slowing down. This number was below zero, a negative 1.3. When it's below zero, manufacturing activity is slowing. Another piece of data, there was quite a few today. I told you in yesterday's live stream, today would be a busy one. The import-export price index for May showed a 0.3% decline in non-fuel imports and a 2.9% increase in non-agricultural exports. That left the year-over-year changes at 5.9% imports and 19.3% exports. Now, another piece of data, business inventories. What did we say they were going to be? Higher. They increased by 1.2% month over month in April, as we expected, following an upwardly revised 2.4% increase in March. Inventory levels are high at all kinds of companies, from retailers like Home Depot to retailers like Bed Bath & Beyond, everything in between, Kohl's, Walmart, high levels of inventory. High levels of inventory cost companies money. Inventory gets stacked away into a closet, forgotten about, becomes outdated, gets destroyed, theft. The list goes on. Many things can happen when you have too much inventory. Now, I understand why companies have too much inventory. We've got a supply and demand imbalance right now. There was stuff ordered for months that finally came in. Okay, what do we do with it? The consumer is not spending as much now. Oh, well, put it in the back for now. That's also going to hurt companies' earnings report. It's going to take money straight from that top line. You watch, it'll happen. And now, looking ahead to tomorrow, market participants, you and I, will get the May housing starts and building permits report. This one will be an eye-opener to the housing market. And then, of course, we get the weekly initial claims report. Both of these come out at 8:30 a.m. Eastern. Now, what to expect tomorrow in the market? I'm going to go back to the SPX here on the chart, which is the S&P 500. What can we expect? We know if we go to the 5-minute view here, and I'll take some of these marks off here. The most, am I just adding marks? Okay, here we go. Now I can take them away. The most important mark on this chart, there's two of them. The first one is at 37.90, and that's the red line that goes across right here. We want to see, when we get into tomorrow, the market hold itself above 37.90, meaning if we have a gap down, that most likely would not be good for the market tomorrow. We need to see 37.90 hold as support. The second area of importance is up here. We need to see the market break above that 38.35. Two very important lines for the S&P 500 for determining where the market is headed. Okay. Investors, tomorrow we need to be looking for signs for a follow-through day to confirm this new uptrend. Now, it's only an uptrend on the 5-minute chart, but it goes from the bottom here and it goes up like this. Okay? We need to see a follow-through on this line. Okay? Breaking above 38.35, you can write that down. We have to break that resistance, and we need to stay above 37.90 as support. So you can see we launched off of it, pulled back, consolidated, launched again, pulled back. Now we consolidate, and we need to launch again and break through it. Or we consolidate, we launch, we break back down, and then we break through. That's another pattern that we could see for a follow-through. And we need to see a follow-through to confirm this. And if we get a follow-through here, then we could get a green day tomorrow. Remember, it's all about probabilities. Nobody knows what's going to happen tomorrow, and we do our very, very best to try to figure it out. Dave, you see a possible head and shoulders pattern. Yeah, possibly. It's a little sideways there. Let me clear some of this stuff off. I can see where you're looking. Give me a quick second to take a couple lines off here so I can demonstrate that head and shoulders. All right, so for the head and shoulders, we're probably looking at somewhere between this red line here for support, maybe going down here as support, possibly. That would break this trend line going up. Although this is just a 5-minute chart, this is not a confirmed trend line because there's only 2 points of contact. We need 3 points or more to confirm that trend line. So if this is the shoulder here, this would be the shoulder, right? This is the head. And then what we would possibly see is then another shoulder like this, and then the breakout. That's a possibility. Really good eye there. Really good eye catching the head and shoulders. That's a possible scenario too. So now we've got 3 possible scenarios, but nonetheless, all of these scenarios that we just looked at need to show follow through. Okay? Need to show follow through. I'm trying to get all these lines off of there. There we go. Now, a confirmed market rally doesn't always work, however. 2022 has shown that many uptrends have been opportunities to sell into strength. And I think we were seeing a little bit of that today, especially after the speech right here. Market ran up from a bottom all the way down here, and then selling that strength. Rising again, selling that strength. Okay? Now, it could also be, like you said, setting up a head and shoulders pattern. That is definitely a possibility, and we could get a shoulder that even looks like this that would break that unconfirmed trend line and then move off of here, right? That's always a possibility too. Now, tomorrow, I would just tiptoe around this market. This market could literally go anywhere. We have our theories, our probabilities on what could happen, but tiptoe around this market. Also, if you are going in on a position, make sure to manage your risk with position size. Make them slow to lower your exposure. Now, if conditions start to improve, you can open that position up a little bit wider. That's okay. Stay alert, be nimble, and just follow the flow. If you're not going to jump in the choppiness, if tomorrow turns out to be choppy and not a full-on rally tomorrow, opening it back up so we can see the daily view here. Here we go. What we need to see too for a sustained rally, look at today's wick, right? I know it's tough to see, but the wick here is almost equal on top here as it is on the bottom here. So it's like we got this ping pong wick today, where equally on the top, equally on the bottom. But what we would need to see for sustained movement up is this resistance line here. It matches up right here with the high that was reached on June the 13th, but it also lines up with the super low hit right here on May the 20th. That's why this area is acting as resistance. So we've got to be vigilant of this right here, and that's 38.35. You could possibly even go up to 38.40. What was the actual high? The actual high was 38.37. So 38.35, 38.40, that's your zone that we would need to break above in order to get a sustained rally tomorrow. But if you're not in the market during this choppiness, build up those watch lists of all the stocks that you want to hold. See, a lot of people, I think, get this a little bit backwards about diversification. In this down market that we are in right now, and this is definitely a downtrend bear market, this is where you want to consolidate your positions. Those weak ones, they should have been gone a long time ago. Hold on to the strong ones. The companies that you go out and buy and like, hold those companies. If you're brand new to the market, that's the best thing to do. If you're wearing a certain type of jacket, you really like it, look that company up. Hold that stock. If you don't like the product anymore, then dump the stock. That's for first-time investors, something just to do. And hold, baby. Hold, hold, hold. If you're in this market for 30, 40, 50 years, holding and slowly adding and growing your positions is the best thing you can do. Honestly, it is. Now, to give you an example of just a couple of stocks that I have on my watch list, one is Enphase. I love Enphase. Inverters, solar, alternative energy. That's one that I like a lot. Let me go back to the comment section here for just a moment. Man, today was great until it wasn't. Instead of selling my position, I accidentally doubled it. Oh, no. Oh, my goodness. I am sorry to hear that. I tell you, you're not alone. I've made the same mistake before, too. I've gone to close out a position, and all I did was add to it. So I feel your pain. Wow. And all I can say is, we have lessons every day. We learn from them. We grow. We become better. I bet now you're probably going to have some sort of checklist or something to keep that from happening again. I feel your pain, definitely. Okay. Enphase, right quick. I've just got two stocks I'm going to talk about just to give you an idea. So Enphase is on my watch list. I own Enphase. I want to grow my position. So ENPH, get my cursor back over here. ENPH is the ticker symbol for Enphase Energy. Now, the other one, and I'll talk about it in just a moment, but it's on Semi. Ticker symbol is ON. Both of these companies, they're consolidating right now. Both of them are holding at or above their 50-day moving averages, and both of them, for the most part, have had pretty good relative strength. Their lines have been increasing over time. Now, Enphase, it's starting to form what I think here. Let's open it up just a little bit. You can see Enphase has been on a massive tear here lately, but then it's been selling off just like the broader market. And right now, its 200-day moving average, its 50-day moving average is all right here at the same place together, right here. And as a matter of fact, those two prices are 177 for the 50-day moving average and 179 for the 200-day moving average. Enphase was up 5% today to $188. So, it's sitting up here. Now, you could read this as a potentially upside down cup and handle. That's a possibility. The buy point, I think, for Enphase here is obviously as low as you can get it. But I think this thing could go up and retest this high right here. And this was, let's see, what was that high? 217, okay? With the stock market, there's only two phases. This is something very easy for new investor. You always have a period of contraction, which is right here in this circle. The candles are real close to each other. They're not really going above or under each other. They're just bouncing around, moving sideways. That's compaction, right? It's compacting. But whenever you have this compacting zone, it always leads to expansion. Let me get a couple of these lines off of here real quick so I can demonstrate this better. Whenever you have contraction, okay, contraction always leads to expansion. Now, that expansion phase can be up, that expansion phase can be down, but you always have contraction, which is right here, which is what it's doing now, which leads to expansion. But remember, that expansion can go lower too. Just keep that in mind. But I think for a trade setup for end phase, if you're not in it for the long haul, and I'm in it for the long haul, but if I can, trade a small portion of the portfolio, I do and I will. So end phase is here, and I'd probably be looking above here. And again, this is at 217. It's top of this candle. It's most recent high back here. So that's end phase, right? In late May, let's jump over to, let me take those marks off. Let's go to on semi real quick. ON, on semi. On semi is its nickname. On semiconductor is more of its full name. So on semi, I like long term, and I have a position in on semi. I want to grow it. So if we look back at the beginning of the month, there's this up and down, almost this. Remember I talked about moving averages act like a magnet? Right here for on semi is like the perfect example of that, because going right through all of these hills and valleys, you have its 200-day moving average. I'll just change that to a different color. So that 200-day moving average is this green line, while the orange line is the stock just moving in this like breathing pattern, right? This exhale, inhale, exhale, inhale, exhale, inhale, exhale. Or maybe I got it backwards. But you see my point. Moving averages always attract the stock. And if you look right here, where it's been hanging out for the past couple of days is right on its 200-day moving average. And as a matter of fact, just like in phase, on semi is also sitting on its 50-day moving average. Okay? That 50-day moving average is at $56. The 200-day moving average is also at $56. So they are on each other. That's a good thing, right? That's a good thing. We're most likely, unless the market really pulls us down, in phase and on semi, I think are getting set up for rallies. Being on that 50-day and 200-day moving average is pretty neat, both at, $67. I think they're probably I think they would probably, if they went into a rally, would head back up to this position right here, somewhere around $68, $70. That would probably be the point where it would stop and start to consolidate again, right? Compact before expanding. Now, onsemi is a chip maker, in-phase inverter, and into alternative energy. Those are two companies that I have on my watch list. Two companies that I really like, two companies that I want to grow my position in. So I'm watching them. These are the times to do that. Even if you're dollar cost averaging, as you are declining, right? As these stocks are declining in the long scheme of things, I mean, you look at onsemi, you don't really see that overall decline, even though this is the daily. This thing's been holding up nice. For the year so far, onsemi, it's down 14.5, or the S&P is down over 20%. So these are the times when you want to expand positions in companies that you like, that you want to hold. And then once the market finally finds its bottom, it gets some structure again, and it starts to actually rally, and we go back into a bear market, that's when you start to diversify more. That's when you start going into, maybe you have some speculative companies that you want to go into. That's the time to do it. That's when you want to diversify and expand what you're holding in an uptrend, not when we're at the bottom or near the bottom or going down in a bear market. Okay, that's everything that I wanted to talk about today. So if you learned something today, do me a favor and click the like button. That helps out tremendously. Also, sharing this video, that helps too. And if it's your first time watching, then please click that surprise button. The subscribe button, that really helps out a small channel like this. And definitely join other investors just like you and me on Patreon. A ton of valuable information to help you along your investor journey. Just click that first link in the description, and we would love to see you there. All right, if you have some questions, now would be a great time to post them. I've been trying to keep up with them as we move along. And just a quick little sip there. You are welcome. I'm glad I can be here. I appreciate each and every one of you. All I want to do is help you and me along this investor journey. And that's what I'm here for. Okay. Would you be going through Amazon? Started a small position. Actually, let me put this up on screen here. Started a small position this week, but looking below 95. All right, let's pull up Amazon. Ticker symbol AMZN for Amazon. I've said this before in the live stream. For Amazon, right now, you want to buy Amazon for AWS, for its cloud offering. You do not want to buy Amazon for its retail. Even Amazon has more inventory than it should. Inventory is up at Amazon. All right, let's look at this. I'm going to put this into the frame. Actually, let's go to the weekly chart. And then I'll go to the daily chart. Because what I'm looking for here, I have this theory, my 2019 theory. So 2019 for Amazon, its highs here, and here. And if we line that up, we line up those two highs, that would be right here, okay? So I have this theory. It doesn't work for every stock, but it does work for most stocks. That companies, these stocks, they're going to come back down to their 2019 levels. You're probably thinking, that's crazy. Why would 2 years, 2.5 years of gains get washed out? Why would these stocks be falling back down to their 2019 levels? Well, the pandemic, I believe, just put in a little placeholder to say, this is where a recession should have happened. This is where a market correction should have happened. This is where a bear market should have occurred, but it didn't, because the market was artificially inflated with all of the quantitative easing and all of the money going into the market. Just think about all the brand new investors who came into the market during 2020. Stimulus check and a Robinhood app. It sent the market straight up. And that's what happened. Now that quantitative tightening is occurring, that interest rates are rising, the bear market that should have occurred in March of 2020, which is, let me take that last line away, which is this right here. That's the V-shaped recovery that occurred in March. Now, Amazon is down to its 2019 highs right now. So if we zoom in here and take a look, absolutely, Robinhood made it like gambling. Robinhood made it too easy, way too easy, I think. All right, on the weekly chart here, we've got resistance on its 200-day moving average, and as Amazon continues to tick down, this will start to curl over and come down. It's really far off of that 50-day moving average, so Amazon's really weak right now. And plus, the bottom line that I drew, that is the 2019 highs. So on the weekly candles here, the 2019 highs are holding Amazon up. Let's go to the daily to get a better perspective of current trends. And it looks like, I mean, we are bouncing right off of those 2019 highs. It's incredible. Getting in Amazon, I think sub 100 is looking like a pretty decent target. It looks like there's a lot of strength. What were these three lows? Let's see here. 102, 101, and 101. If Amazon, and I think the market may pull Amazon down even more. What is it down so far on the year? 35%. Okay. I think the S&P 500 is going down 30% before we're finding a bottom. And we're about 9-10% away from that bottom right now. And I think it's going to occur closer to October. We'll get a couple of bear market rallies between now and October, but I think that's where we're headed. And then maybe October we can see a turnaround, but if we go into a recession at the beginning of 2023, that's not going to be pretty either. So I would set a limit order at $99.99, or you have it at you looking at 95 or below, I think that's fair. I think it would definitely go there. It's definitely got some strength here at this $101 level. As a matter of fact, let me go into I want to go into the 5-minute chart, and I want to look at these dailies, and I want to look at the volume profile on the day. I want to go to this day where it hit the low. So I want to see where were investors this day. So the red line, which would have the highest area of buying and selling going on, is looking to be $102.91. Is that it? Let me look at the chart up here. Yep. And the Bollinger Bands around this line too are at 102 and 103. So there's quite a bit of volume there, and you can see that volume here on the volume profile. There's a lot right here, and then hardly any right here on the top. And then we've got hardly any, like a ghost, down here at the bottom. But I would suspect that here, this is probably where I would expect to see the most buying happening. Surprisingly, it wasn't on the day, but the trading that occurs on the day will dictate where it's going. And you can see these waves. I've got too many lines on here now. I need to take a few of them away. You can see this wave. It found support here, and then it really traded on it right there before breaking down, and then finally to end the day at resistance before gapping up. So there's a lot of activity there around that. I'm going to call it 103. It's really, really close to it. So that's Amazon. Yeah, if I would put a limit order at 95 and hold it right there. I think it'll get there. I really do. And again, it's got that strong 2019 line there acting as support. But when these earnings come up, oops, wrong. There we go. No, what am I doing? I don't want to draw a line. I just want my cursor back. There we go. EPS was 16 cents, 119.7 billion in revenue. When these earnings come in and possibly miss due to this contraction we're seeing in retail right now, that would send it probably below that 103 support area. However, the AWS side, like I said when we started looking at Amazon here, that's really what I would be buying Amazon for. I think retail is it's done for a while, but retail isn't out at Amazon, so don't get me wrong on that. It's just right now in our current environment, you're buying Amazon for AWS. That's where the growth will come from. It will not come from retail. All right. Robinhood made it easy. It sure did. LOL, back when I was doing random market orders and doubling my money. Yeah. Yeah, those pandemic days were interesting for sure. You know, I really, you know, you could go back and do things over. See, I didn't start this channel until November of 2020. So let's see, that would be like right here. I wish I would have started talking back here at the bottom, or even going back to 2019. I wish I would have started this channel sooner. But I don't like to be on a camera. I'm very shy of a camera, so it took a big chunk to get that first video out there. Now I'm totally more comfortable with it, and I just wish I would have started sooner. You know, if you ever have a side hustle, a side job, and you love it, don't wait. Don't wait. All right. Wow, we've been going hour and 21 minutes. Do you guys want to wrap it up, or do you have some more questions you want to dive into? Just remember, tomorrow, tiptoe into the market. Small order sizes, small positions. Don't try to bet big. Watch for a follow through in the market. That's the big thing. I'll pull up the SPY here on the daily. Open this up, and just like SPX, it's following this this trend line lower, and I really do. I think it's headed for lows down even further than where it is, but looking for a follow through on the SPY. You know, it's got to break this 384, 385 area for a follow through. It got to 383.9 today. It's got to break that 385. The high a couple days ago was only 381, so it cracked that today. But it's this low on May 20th, which is 398. I'm sorry, 380. So breaking this 385, that would be the follow through for the SPY for a rally to possibly catch on and go higher. Let's see. I was wondering why I didn't start earlier, or why I started to begin with. You're very welcome. I must say, Dave, that's the point right there. That's the point. You've nailed, got it. That's exactly why I'm here. Exactly. No, I was wondering why Apple was dropping, and I found your channel. Oh, cool. Cool. I'm glad you stayed. I really am. I'm glad you stayed. As a matter of fact, let me pull up Apple, and then we'll close it down. AAPL is the ticker for Apple. You know, I don't typically bring up individual stocks unless it's obviously something that you guys are asking about. But I love talking about individual stocks. Now, Apple here, Apple is going to go lower. It is. I know we've had this big fall the past few days, and of course, Apple is a big elephant in the room. But if we're trying to figure out Apple here, if I'm waiting. If you see this, maybe not. There's this orange dotted line right here. It's right at $130 for Apple. That's where I have a limit order set right now for Apple. That's why it's an orange dotted line here. So I'm just waiting for it to get there. I think it will. The TradingView is lagging just a little bit as I pulled it up. Now, see, Apple is one. If we wanted to use the 2019 theory, it just doesn't work, right? Apple is way too far extended. December of 2019 would be right here, and that's just a trend line there. Turn my highlighter off. Found the channel by luck. I'm glad the luck was in both of our favors. That's awesome. I'm honestly, I'm glad you sticked around. I'm glad you stayed. Let's see here. See, Apple 2019 theory, it just doesn't work. Most tech stocks might not fit into this. Apple is one of them. 130, that's an area for Apple where I am definitely have a limit order for Apple for a long-term hold, not for a trade. All right. Okay. Well, I'll wrap it up here. It is 9:30 or 9:29 Eastern, and I'll see everybody tomorrow after the market closes for another live stream. Talk about what happened, why it happened, and what to expect. And of course, to answer your questions, because that's the fun part. And then the investor community on Patreon, I will see you there in the morning. And we'll talk throughout the day. So have a wonderful evening. Thank you for joining me, and I'll see you guys in the next video.